Oh my gosh. Now, seriously? The IMF is giving us terrible warnings. JP Morgan, more warnings. They gave us bad warnings yesterday. Now they got new and more warnings. We get some charts to let us know how much more pain we might have. And the Bank of England is losing their mind again. At the same time, Putin's already lost his mind, worsening the wheat crisis in the Baltic Sea. And folks, this just sucks. Like, we need a prayer potion because I feel like I've been having this cup every day, and every day I'm praying, and it just ain't getting better. But sometimes that's what we need to get to capitulation in the market and the bottom. So let's talk about what we heard today and how to break it apart. So first, the International Monetary Fund cut global growth to 2.7%. This is really nonsense. We are going to be negative. In January of this year, actually, they told us growth would be 3.8%. And in July, they told us growth would be 2.9%. Now they're saying 2.7%. And I wouldn't be surprised that by February of 2023, they look back and say, yeah, dang, it was negative. We were in a recession. I mean, really, is that really that much of a surprise? The United States already has over 2 quarters of negative GDP. I mean, we're in a recession. But the IMF went a step further, and they told us that in 2023, we'll actually feel like we're in a recession. That's what the chief economist said, and that's kind of scary, because that's when you actually have layoffs happen. That's when you actually lose your job. That's when you actually start panicking about, oh my gosh, I can't pay my mortgage. And that's when we actually start seeing people sell their homes because they have to, not because they want to try to time the market. Folks, today, this morning, I tweeted about mortgage rates, and I never thought I would see this in my life, ever. Okay, I started in real estate in 2010. It was right before the bottom of the market, and I never, ever would have expected I'd seen this. The best credit score you generally need for a loan is 740. Well, 740 in basis points is 7.4%. And that's what the 30-year fixed is quoting today. 7.4% for the 30-year fixed on, if you just Google mortgage rates. That's insane. That's how you start feeling pain for everyday individuals. And this isn't designed to be a real estate video. I know some people are going to go, oh, well, if you locked in a low mortgage rate, you don't have to move. Sure, until you lose your job. That's when things really get scary. So much for lagging comparisons, or I should say lapping comparisons, that is, where we look back at high inflation from a year prior and we're like, oh, okay, inflation's, lower now, because the IMF actually doesn't believe us lapping high inflation at the end of last year and beginning of this year is going to help much. They actually believe that global inflation will be at 8.8% later this year and will remain higher for longer, and it will end next year with global inflation at 6.5% and 4.1% by 2024. That means potentially a hawkish Fed if we at all align with that until 2025. Forget about a 2023 U-turn. This sucks. This is not going to be a bad 2022. This is setting up to just be a bad few years. Terrible. JP Morgan has come out with some more clarity and suggested that if we end up missing CPI on Thursday, CPI comes out at 5:30 a.m. on Thursday. I'll be live. I hope you're there. I'll be live covering it. The expectation from Bloomberg and JP Morgan is that CPI will go down to 8.1%. JP Morgan believes anything above a headline read of 8.3 is going to lead the S&P to drop another 5%. It dropped 4.3% on September 13th. On top of that, we have a little bit of a scary chart when it comes to multiples, because we've already talked about this idea that, hey, the first phase of a market crash is multiple compression, and that the second phase is an earnings recession, and that maybe phase 1 is complete, that multiple compression is complete. Wrong. As you can see here, these are price to earnings multiples. The little yellow lines there show you where the multiples bottomed, and we are higher right now than every single prior bottom as they've aligned with recessions. Yeah, so that means the S&P 500 price to multiples, price to earnings ratios, still sitting close to about 16-ish, 16, 17-ish it looks like, 17 and a half, right around there where that little red line is over there on the right corner. That means an additional, 10% is going to align us with about half of those arrows. So another 10% to go just in multiple compression. It's not even earnings compression yet. Now, hopefully, earnings season that's coming up now isn't as bad as we fear. The last two earnings cycles have actually been pretty good. The Q1 earnings cycle was pretty decent with the exception of Netflix and some others, but overall pretty decent. Q2 was pretty decent, and hopefully Q3 is decent as well, because right now any bad news is just terrible news. But then again, like we said in January, good news is also bad news. The UK is also in complete disaster. The Secretary of the Exchequer told us a few weeks ago that the UK, the United Kingdom, is a nation of entrepreneurs, and therefore it was time to cut the top income tax rate from 45% to 40%. That night, he allegedly went partying with hedge fund managers, and at the same time, the Great British Pound plummeted as investors feared Great Britain was stimulating too much, with tax cuts, housing tax cuts, stamp tax cuts, energy subsidies, and business subsidies. Some of the biggest tax cuts in over 50 years. At the same time, we're supposed to be tightening, not stimulating, so that's why the currency sold off. Things got so bad that pension funds almost went bankrupt as their bonds and some of their longer-term assets started becoming valued as nearly worthless. The pound crashed so low and markets became so turbulent that the Bank of England and their emergency financial stability arm had to step in to bail out, that's their central bank, right, to bail out the bond market, promising to buy an unlimited amount of bonds for a few weeks. Now, we thought the pain was over. The pound has stabilized around $1.11. Yet the Bank of England just said today that it needs to expand the scope of its bond purchases, its quantitative easing, to include inflation-linked debt to avert what it's calling a fire sale in bonds. In other words, things are getting worse. Volatility is not getting better, it's getting worse. You don't even have to understand volatility or skew or bonds. All you have to do is look at this chart and go, see, pretend these are little heartbeats, and on the far right, you're like, oh my gosh. It's just bad. It's just bad. And so this creates this triple set of bad things because, see, when you're conducting quantitative easing, you create something that is essentially counter to inflation reduction measures. You're easing by buying unlimited amounts of bonds. You're saying you're going to raise rates to combat inflation while you're printing money. Those two kind of offset each other, and we don't really know what's going to break. But it also sets a bad precedent for other countries, because other countries might say, maybe we need to do that as well, which then you have a global nightmare in actually trying to bring inflation down, because then you don't, because you're printing at the same time as you're hiking. And you also create moral hazard for the pension funds. Like maybe some companies just suck and they just need to go bankrupt. But then the problem is, does that mean millions of people relying on pensions don't get their pensions anymore? That's when you get too big to fail. And see, we're starting to get cracks in our own bond market as well. The chief investment officer of Boca Capital Partners this morning on Bloomberg talked about disruptions beginning to occur in our own bond market. This is actually similar to what JP Morgan and Ben Bernanke are now calling a potential for a financial accident, a disorder. These are really bad phrases. This basically means things have gotten so bad that some weakness somewhere is going to get exposed. The 10-year treasury at 4% is terrible for real estate. And the semiconductor space is a complete disaster. 32% profit miss on Samsung. Taiwan Semiconductors plummeting over 6%. NVIDIA, AMD getting destroyed and reamed, but don't worry, Nancy Pelosi already sold. Jamie Dimon calling for another 20% decline in the S&P 500. Credit Suisse and their credit default swaps becoming ridiculously expensive because Credit Suisse is such a bloated company with too frickin' many employees. They honestly need to cut 10 to 15,000 employees, in my opinion. They're saying they're going to cut 7,500. I don't think it's enough. You look at their financials, they're absolutely terrible. We went through their financials in the course member live stream, but you're always welcome to join the course member live streams. We've got a coupon code actually expiring this Friday. And we've got some benefits going away this Friday as well, like unlimited access to to our live streams. So if you want lifetime access to those live streams, make sure you join before this Friday evening. But folks, we're starting to see spreads on everything rise. Even bonds on Apple, spreads are rising. Mortgage bonds are rising. And it's not just the rates, it's the spreads. So it's the difference between the risk-free rate and the rate that they're going for is widening. And that's a sign of concern for a broader contagion in the markets. And it's scary. We don't yet know what's going to break, but it's possible that in the next 4 months, something's going to break really bad. And it's going to lead to substantial capitulation in the markets. You're going to have to be prepared for that day. It's going to be really bad. Now, no guarantees. I would love to say that we're at the bottom now, but if that day does come, it will probably mark the bottom. The actual bottom will probably be marked by a lot of hell. And the only way you're going to survive is by making sure you are not in margin, because the margin calls on that day are probably going to be glorious. So stay in a margin, get out of debt, and do what I've been telling you since January. I hope so. Increase your income. Now is the time to grind. If you're thinking, oh, should I just take the weekend off? No. Grind. Get a second job, make more money. Cash is king right now. So go out there and grind. You grind hard these next 2 years, this year, 2023, 2024, you could set yourself up for life just by grinding, getting yourself in the market at hopefully near lows, and then reaping the benefits in the long term. That's my belief. If you want to talk to me directly, make sure you join the courses on building your wealth. If you're an accredited investor and you want to get into my real estate startup house hack, I think we're going to do phenomenal things close to the bottom of the market in real estate. I'd love to have you. Go to househack.com to learn more. And folks, we'll see you in the next one. Good luck.